Cryptocurrencies and traditional banking are two ways people can access financial services. However, it is important to understand the differences between the two in terms of environmental impact and transaction costs. Traditional banking often comes with high transaction costs, including fees and time delays. These costs can have significant environmental impacts, such as increased overhead, transportation, fuel costs, and building material carbon emissions. On the other hand, cryptocurrency transaction costs can be significantly lower. When it comes to the environmental impact of banking, traditional banking requires significant energy consumption to maintain physical bank branches and infrastructure. In contrast, cryptocurrency transactions have relatively lower energy consumption, especially with the emergence of eco-friendly alternatives like proof-of-stake consensus algorithms. This suggests that cryptocurrency has the potential to enable more sustainable financial practices. Another key difference between cryptocurrency and traditional banking is security and privacy. Traditional banking has a history of security breaches, data leaks, and identity theft, whereas cryptocurrencies use advanced cryptography and decentralized networks to protect user data. Cryptocurrency also has the potential to empower individuals to control their own financial data and assets. Lastly, accessibility is a critical issue. Traditional banking is often inaccessible to marginalized communities and those in developing countries. In contrast, cryptocurrency can be accessed by anyone with an internet connection and a digital wallet. This suggests that cryptocurrency has the potential to enable greater financial inclusion and empower underserved populations. When we think about traditional banking, one of the first things that comes to mind is the cost and inconvenience of physically going to a bank or ATM. Driving to the bank, finding a parking spot, and waiting in line to withdraw cash or make a transaction can be time-consuming and expensive, especially for people who live in rural areas or far from bank branches. In addition to the direct costs of transportation and parking, traditional banks often charge fees for various types of transactions, such as ATM withdrawals, wire transfers, and international transactions. These fees can add up over time and become a significant burden for people who need to make frequent transactions. On the other hand, cryptocurrency transactions tend to be much cheaper and more convenient. With just a few clicks of a button, people can complete transactions from the comfort of their own homes, without the need to physically travel to a bank or ATM. This can save time and money, especially for people who live in areas with limited access to banking services. Moreover, traditional banking has a significant environmental impact. Physical bank branches require a lot of energy to maintain, from lighting and heating to cooling and security systems. And when we consider the transportation and fuel costs associated with moving money from one place to another, the impact can be even greater. In contrast, cryptocurrency transactions are typically done digitally, without the need for physical infrastructure or transportation. This reduces the environmental impact of financial transactions, which is important as we continue to prioritize sustainability and environmental responsibility. By considering the energy costs of driving to the bank or ATM, we can see the potential benefits of using cryptocurrency for more efficient and eco-friendly transactions. Cryptocurrency and traditional banking have very different environmental impacts. Traditional banking requires a significant amount of energy to maintain physical bank branches and infrastructure. This includes things like heating, cooling, lighting, and powering bank equipment. In addition, traditional banking requires a lot of transportation, both for customers to physically go to bank branches and for banks to transport cash and other materials. This transportation contributes to fuel consumption and carbon emissions. In comparison, cryptocurrency transactions generally require much less energy. With the emergence of eco-friendly alternatives like proof-of-stake consensus algorithms, the energy consumption of cryptocurrency transactions can be even further reduced. This can help to minimize the carbon footprint of financial transactions and make the financial industry more sustainable. It's important to consider the environmental impact of our financial practices and to explore ways to make them more sustainable. Cryptocurrency has the potential to offer more environmentally friendly alternatives to traditional banking. Traditional banking is vulnerable to security and privacy risks due to the concentration of sensitive customer data and transaction processing in a few centralized entities. These entities require significant amounts of energy to maintain physical branches, data centers, and other infrastructure. This infrastructure includes lighting, heating, cooling, and powering bank equipment, all of which contribute to increased energy consumption and carbon emissions. Furthermore, traditional banking requires a lot of transportation for customers to physically go to bank branches and for banks to transport cash and other materials. This transportation contributes to fuel consumption and carbon emissions. In contrast, cryptocurrency transactions require significantly less energy due to their decentralized nature and digital infrastructure. Cryptocurrency networks use advanced cryptography and consensus algorithms involving multiple nodes in the network to verify and process transactions, eliminating the need for centralized entities that consume significant amounts of energy. This makes cryptocurrency transactions more efficient and environmentally sustainable. The energy cost of traditional banking is much higher than the stated cost, when you include factors such as transportation for workers and customers to the bank, transporting cash, and building the bank branches themselves. According to a report by Chime, a digital bank, traditional banking consumes 17 times more energy than Bitcoin transactions on average. This is because traditional banks require a lot of energy to power their physical branches, ATMs, and other infrastructure, and they also require significant amounts of energy to transport cash and other materials between locations. Overall, while traditional banking may appear to have a lower stated energy cost, the real energy cost is much higher when you factor in all the associated costs of physical infrastructure and transportation. The energy consumption of traditional banking includes not only the energy required to operate bank branches and data centers but also the energy required for transportation. According to a report by the World Wildlife Fund, the banking sector in the UK alone consumes approximately 4.5 billion kilowatt-hours of electricity each year, which is equivalent to the energy required to power over 1 million homes. In addition, the report estimates that transportation accounts for up to 80% of the energy consumption of traditional banking services. To put this into perspective, consider the energy required to transport cash. According to a study by the Lawrence Berkeley National Laboratory, the energy required to produce, transport, and process a single dollar bill is equivalent to 1.2 kilowatt-hours of electricity. This may not seem like much, but when you consider the billions of dollars in cash that are transported every day, the energy consumption quickly adds up. The high salaries paid to executives and other employees in the banking industry have significant energy costs associated with them. When executives are paid exorbitant salaries, it leads to a concentration of wealth and power within the industry. This, in turn, can lead to increased energy consumption as these individuals tend to live high-consumption lifestyles, including multiple homes, luxury vehicles, and private jets. Additionally, the high salaries paid to executives and employees contribute to the overall cost structure of the banking industry, which is heavily reliant on fossil fuels. The energy used to power the buildings where banks are headquartered, transport employees to and from work, and keep data centers running around the clock all require significant amounts of energy, much of which is generated from fossil fuels. Furthermore, when banks fail and require bailouts, this also has significant energy costs. Bailouts require massive amounts of money to be injected into failing institutions, which can lead to increased energy consumption as the government is forced to issue bonds or print money to cover the costs. This, in turn, can lead to inflation, which can drive up energy costs even further. Overall, the hidden costs of traditional banking, including high executive salaries, marketing and lobbying expenses, and bailouts, all have significant energy costs associated with them. As we move towards more sustainable and equitable financial systems, it is important to consider these costs and work towards reducing our reliance on fossil fuels. Moreover, the failure of a bank can also have significant energy costs in terms of the physical infrastructure that needs to be dismantled or repurposed. For example, when a bank goes bankrupt, its branches and other physical assets may need to be closed, sold, or repurposed, which can result in significant energy costs in terms of demolition, construction, and transportation. In addition, when banks engage in misleading accounting practices or become insolvent, it can also result in increased energy costs in the form of legal and regulatory intervention. For example, If a bank engages in fraudulent accounting practices, it may face significant legal and regulatory penalties, including fines, legal fees, and increased oversight, which can be very costly in terms of both money and energy. Finally, the impact of bank failures and bailouts can also have significant energy costs in terms of their broader economic and social impact. For example, a banking crisis can lead to widespread job losses, lower economic growth, and increased inequality, which can have profound social and environmental consequences, including increased energy consumption and carbon emissions. In summary, while traditional banking may be limited in its accessibility, cryptocurrency has the potential to enable greater financial inclusion and empower underserved populations. It's important for individuals and institutions to consider both options and their potential impact on accessibility when making financial decisions.